Dean Baker, as many of you know, is co-director of the Center for Economic and Policy Research. If I read his publications list and his bio, we'd go on forever. But I will simply say that if you don't read his blogs, posts, you should do so immediately because they're extremely useful. And if you want to give them the access to it, I'd be happy to have you do so. And let me turn it over to you.
Okay, thanks. I appreciate the opportunity to speak here. I'll give you my, since he did the plug, I'll carry through www.cepr.net, and I have a blog, Beat the Press, that you can find on our main page. We also have the CEPR blog that I'll advertise as well. I appreciate the opportunity to be here, and I appreciate having David speak before me. He made a lot of the points I would want to make, so it gives me a chance to go off on some different ground. I'll also say I really do want to compliment the Independent Evaluation Committee, and like Damon, I just wish we had this for the Fed, for the Treasury, for the Securities and Exchange Commission, on, and it is very nice to have that as a model. Having said that, naturally, I'm going to say you guys didn't go far enough. The 3 points I want to make is, first of all, that this was a crisis that was easy to see, and I'll go through the basic story quickly, but I emphasize the issue that it's a housing bubble. There was a financial crisis, but I'm going to emphasize the housing bubble. I think that's first and foremost the fundamental story here. My reason for saying that is housing bubbles are simple, financial crises can be complicated. The second point is that it is important to understand there were other tools. This is a point I make in passing. There's other tools than the interest rate. So I don't know how many times I get into arguments, debates with economists, and I go, oh, so you would have wanted the Fed to raise interest rates. And I say no, and then they go, you would have wanted the Fed to raise interest rates. No. That's a last recourse. I want to talk about the other tools. The other tools don't work, then you raise interest rates. Then I want to pick up the point that Damon made, perhaps in passing, but I really want to drive this home. There have to be sanctions. That means economists get fired. I'll let you think about that one for a moment as I go through the other 2 points. It always strikes people, you usually think I'm joking. I'm not. I'm an economist. We believe in sanctions. We believe in discipline. If you mess up on your job, you get fired. All right, well, to start the basic point, easy to see, as I said, I think it's a housing bubble. I'm not saying that to be contentious. I look at the economy today, and, you know, Damon's pointing out that we have 25 million people unemployed, underemployed, giving up work, looking for work altogether. We have millions of people who've lost their homes, millions more who will lose their homes. And I go, how would that have been different if we did not have the financial crisis? What would be different today? And basically, I'm pretty hard-pressed to say very much. Okay, I don't doubt, I'm not disputing for a moment that if, you know, we could have thought of worse scenarios. If we go back to September, October of 2008, we could have thought of worse scenarios. You know, so we kept the financial system operating. That was a good thing. But if we look at the economy today, given that we've had a plunge in house prices, which was caused by the collapse of the bubble, how would it have been different if we didn't have the financial crisis? I don't see any fundamental way it would have been different. So that's why I emphasize the housing bubble. It's not just to be contentious. I really do think that that's true. And I understand it's an international story. The housing bubble was not just a U.S. phenomenon. There were bubbles in Spain and Ireland and England. Most of the OECD countries, not all of them, Germany, for better or worse, escaped that. And there were a few others. But and it took different forms. But, you know, but it was a story, first and foremost, to my mind, of a housing bubble. Now, in saying that, it astounds me, this was not something you had to be hugely prescient to see. We had a 100-year-long trend in nationwide house prices in the United States, 100-year-long trend in the largest market in the world, where house prices just tracked inflation. That's a real long trend in a really big market. My reason for emphasizing that is, you know, as an economist, usually we just look at post-war data. If we have a trend 30 years, that's a big deal. It's 100 years. And it's a large market. You know, you could have erratic movements in the price of chrome or zinc. We all understand that. Well, you know, these aren't huge markets. Things affect them, you know, in odd ways. It's a huge market. Okay, so what was it that led to a huge divergence in house prices? By their peak in 2006, house prices adjusted for inflation were more than 70% above their long-term trend. So what explained that? You'd think as an economist, you'd want to go, okay, well, what was this? And I followed this closely, of course, and I first actually started following this closely at the instigation of Alan Greenspan when he said there was no bubble. That was 2002. And at that point, house prices had already risen by 30%, adjusted for inflation, above their long-term trend. And he said, well, you know, there's been a big growth in income. You go, no, there hasn't been a big growth in income. You presumably know better than that. He's the chair of the Federal Reserve Board. He has data. There was good growth 96 to 2000, but that was not didn't exceed the growth in the post-war boom period, 47 to 73. And of course, we had the recession in 2001. Income had stopped growing, was shrinking. That made no sense. He talked about population growth. Well, again, come on, Alan Greenspan knows population trends in the United States. He mentioned immigrants. Immigrants are buying $450,000 homes. But on top of that, everyone knows that the demographics of the United States are dominated by the baby boom cohort. So if you want to talk about a housing bubble driven by population, that should have been the 70s and 80s when the boomers were first forming their own households, not in late 90s and 2000s. That made no sense. Supply side, he talked about environmental restrictions on building. It wasn't exactly the heyday of environmentalism, and limited supplies of buildable land. But, again, there's always been limited supply. There's always been a limited amount of land in Manhattan. That wasn't new in the late 90s. So this literally made no sense. Now, if you wanted to buy the fundamental story, you'd look at rents, right? So if there really are fundamental factors driving up house prices, there's got to be something going on in rents. So what was going on in rents? Well, rents outpaced inflation by about a percentage point, 96 to 2000, and then they were totally flat. Nothing going on with rents. That should have bothered me. The last part of that story was that you had record vacancy rates already as early as 2002. That's not consistent with the run-up in house prices being driven by fundamentals. This is 2002 we're talking about, not 2005, 2006, 2002. Okay, and it only got worse, of course. Now, I don't understand how you missed that. To say, oh, it wasn't my job, how'd you miss that? That's kind of amazing to me. This was a really, really big deal. I don't understand how you missed that. And again, I'm most familiar with the U.S. market. You can tell comparable stories for Spain, for many other countries. I don't really understand how that is missable. The last part of the story, I had a number of people tell me that, well, we could have dealt with this, so what if house prices collapse, no big deal. Well, again, a little arithmetic. I'm really fond of arithmetic. I always think that all the economists in Washington were so smart they skipped directly from second grade to fourth grade because they don't seem to know third grade arithmetic. The basic story here was you had about 5% of GDP tied up in construction, extraordinary rates of construction, that was going to disappear when the bubbles burst. There was also a bubble in non-residential. I won't get into that. But about 5 percentage points of GDP. We also had consumption being driven by an $8 trillion housing bubble. I talk about the housing wealth effect. I get economists look at me like this is some crazy Marxist invention. I learned this in grad school first year. I thought everyone knew this. I don't know. It's not an alien concept. So you have $8 trillion in housing wealth created by a bubble. That led to somewhere around $500 billion a year in annual consumption that would not be there when that bubble wealth disappeared. Now, I don't know anything in economics that tells me where we're going to replace 10 percentage points of GDP in a short manner. Now, if someone knows that, please tell me. I've never heard it. I don't know how you do that. It should have been easy to see that this was going to be a really, really bad story. The bubble would burst. It'd be a really bad story. Financial crisis was a likely outcome. It was a very likely outcome. Again, you'd look into specifics, and, if you did that, of course, you would see exactly where it would occur. But losing 10 percentage points of demand of GDP, that is not going to be easily replaced. That is a very, very bad story with or without a financial crisis. Okay, second point, interest rates. I always get this story that, okay, you want to raise interest rates. Well, the economy was weak. The Fed was right in leaving interest rates low in 2003, 2004, 2005. I was at the A in January of 2004, and I went to one session where Alan Greenspan was patting himself on the back for being so smart and just letting the stock bubble rise and collapse of its own accord, and everything worked out great. And then I went to a next session, and Ben Bernanke, who at that time was on the Fed as a governor, explained why they still had a 1% discount rate or a federal funds rate because the labor market was so weak. Those two are inconsistent, but no one seemed to think that. In other words, we actually did have a lot of fallout from the stock market crash. It took a long time for the economy to recover. They were right to leave interest rates low. The economy was very weak. What else could they have done? Well, I always said the first thing that the Fed could have done is talk. And I don't mean Alan Greenspan mumbling irrational exuberance. What I mean is putting out the information. They could ignore me. They don't have to pay attention when Dean Baker says there's a housing bubble. When Alan Greenspan says there's a housing bubble, not just, he thinks there's fraud. No, he puts out the data. We have an unexplained run-up in house prices. People have to pay attention. That would be the focus of national debate. And there was no other side to this argument. I debated a lot of people, the chief economists at Fannie and Freddie, a lot of other people. They said nonsense. I have a hard time believing that the Federal Reserve Board had devoted its staff to documenting and publicizing the existence of the housing bubble. That would have had a serious impact. Also, just other things, the Fed does have regulatory power. They didn't finally come out with their guidance on mortgage issuance, what was the summer of '08? I mean, this is a joke. I mean, things like, when banks issue mortgages, they should assess someone's ability to pay based on a reset rate, not on a teaser rate. I mean, these are kind of stupid things, but, it would have been helpful if the Fed had done even minimal steps, much less cracking down on fraudulent loans, which were widespread and easily to see. I had access, I knew of this, and I don't have regulatory powers. It's hard to believe that the Fed, people at the Fed did not know. The last one of that is, I would have raised interest rates as a last call. That, if at the end of the day, the Fed had pulled out all the stops, they put out all the information, and the market still ignored it, house prices continued to go up, I would have raised interest rates. That certainly would have been better than letting the bubble continue to expand. But you first take the steps that you have available that don't have the negative consequences, slowing the economy, that interest rates would have. Okay, the last point, and I really do emphasize this, it's not a joke. If we're economists, we should believe people respond to sanctions. And there's a large literature on the importance of firing. In fact, the OECD, I've argued with a lot of the OECD, they're very unhappy that you have employment protection legislation in most countries other than the United States. You can't just fire someone in France and Germany. You have to establish that they didn't do their job. So it's not easy to fire people. And they argue that's a bad thing. You should just be able to fire people. Well, these were people that really did not do their job. This was not a minor mistake. This is the school bus driver who comes to work drunk, drives into oncoming traffic, and all the kids get killed. And then they come back into work the next morning and go, how you doing? I mean, this is kind of amazing, but the idea, that you would fire anyone, we get this, who could have known? Well, who could have known should not be acceptable. An economist that was doing their work did know or would have known. And we have a lot of economists, obviously not just at the IMF, at the central banks, at other institutions, that did not know they should face serious career consequences. And again, this counters the groupthink. You will change groupthink a lot if your answer to why didn't you see it was, oh, Joe over there didn't see it, or my boss didn't see it. No, that's not acceptable. You're paid, these people are paid pretty good salaries, a lot better than most people in this country, hell of a lot better than most people in the world. They should be able to think independently. If they're not, well, why don't we just hire a kid out of high school and pay him the minimum wage? So I'm very serious about that. If you don't have people that get fired making a complete disaster like this, I don't see how we can expect any change in behavior. If we don't have people at the IMF and other institutions thinking that if they don't do their job, if they don't think independently, they face a real risk, then they're going to do the exact same thing that they did before this crisis. They're going to do what their bosses want them to do. They'll keep their mouth shut. They won't speak truth to power. And the only question is, when does the next crisis come? So I'll stop with that.